Hey traders, welcome back to my channel. In this video, we will be discussing some of the best trendline strategies. So, first of all, what is a trend line? Basically, a trend line is a line we draw using swing highs and swing lows in a trending market. For example, you can see here that the market is clearly in a downtrend. It goes down, then up again, followed by another down and up, and so on. Usually, when the market is in a downtrend, it creates lower lows and lower highs as it moves forward in this formation. Okay, now this is in the downtrend. We can draw the main trend line using the lower highs, like this. And in addition to that, we can draw another supporting trend line below the candles using the lower lows, like this. These two trend lines will help us understand the price movement and potential areas of resistance and support in the market. Now let's check an example of an uptrend. You can see here that the market is clearly in an uptrend. It goes up, then down again, followed by another up and down, and so on. Usually, when the market is in an uptrend, it creates higher highs and higher lows as it moves forward in this formation. Okay, now that we've identified the uptrend, we can draw the main trend line using the higher lows, like this. Additionally, we can draw another resisting trend line above the candles using the higher highs, like this. These two trend lines will help us understand the price movement and potential areas of support and resistance in the market. Now, let's understand why we draw trend lines. The first reason is that trend lines act as support and resistance. The upper trend line provides resistance, and the lower trend line provides support. However, we should not blindly take trades based on these alone. We need to consider other factors before making trades. We will discuss all of these in this video. And the second reason to use trend lines in trading is to identify potential reversals in the market. When a trend line is broken, it provides us with an opportunity to consider a possible trend reversal. In a downtrend, we draw the trend line above the candles. When the price breaks this trend line, it suggests a potential reversal may occur, indicating that the price might start moving higher. Conversely, in an uptrend, we draw the trend line below the candles. If the price breaks this trend line, it signals a potential reversal, indicating that the price might start moving lower. To draw a trend line, it's essential to have at least 2 key points on the chart. Additionally, it's important to treat the trend line as a zone or area rather than a straight line, as prices often fluctuate around the trendline area. Now, let's learn how to draw a trend line. Drawing a trend line is a simple process. To get started, open your trading platform and navigate to the Tools section. From there, select the Trendline tool. Next, position your cursor at the first key point of the trend you want to draw. Then, move your cursor to the next key point along the trend line. It's important to identify at least 2 key points to ensure the trend line's accuracy. Once you've established these points, move your cursor slightly forward to complete the trend line. By following these steps, you will have successfully drawn your trend line and can use it to analyze market trends effectively. When drawing a trend line, many traders often ask me which part should be touched, the body or the wick. The solution is to draw the trend line in a way that touches as many key points as possible. For example, in a downtrend, we draw a trend line that touches some wicks and some bodies, ensuring that we maximize the number of key points touched. Remember to look at both the wicks and the main body of the price movement at key points. I hope this concept is clear to you now. Now, let's learn how to trade by combining price action. There are 2 ways to approach trading: trend trading and reversal trading. Let's start by understanding trend trading. We look for a specific setup where the trend line, support, and resistance come together at one point. This point is called the area of high confluence, which means it's a place where different types of traders are willing to take trade positions. Let's understand this concept more clearly. Look at the market scenario where we had a support level that was previously helping the price to rise. Now it becomes a resistance level, preventing further upward movement. In this situation, different traders use various methods to make their trading decisions. Some traders choose to trade based on the resistance level, considering it as a critical point to watch. Others use trend lines to guide their trades, looking for patterns in the price movement. Candlesticks are another popular tool used by some traders to make decisions. As for us, we prefer to trade based on the area of confluence. This means that we look for a combination of factors, such as the resistance level, trend lines, and candlestick patterns coming together at the same level. When multiple indicators align, it strengthens our confidence in making a trade decision at that particular level. Since there are different types of traders using various strategies at this level, it becomes an area of confluence, indicating significant importance in the market. As a trader, let's break this down and understand it clearly. In the current market, we are experiencing a downtrend. As professional traders, it is essential always to follow the trend. In this situation, we should look for opportunities to trade short positions. To do this, we first draw a trend line. Additionally, we notice that there is a support level, which, after being broken, becomes a resistance level. Now, we identify an area of confluence, where different factors come together to create a significant level on the chart. Price starts to approach this level, and we can see multiple candles reacting to this point, indicating that they are failing to break through it. This gives us a clue that we need to draw a mini trend line, like this. If the price breaks this mini trend line, we can consider taking a short position. Overall, the big trend is bearish, but there's a short-term bullish trend causing some concern. There's a chance that the price might break this level and move higher. To handle this situation, we've drawn a mini trend line. If the price breaks this mini trend line, it confirms that the short-term bullish trend has ended. At that point, the overall trend will be bearish again, and we can consider taking a short trade position. Sure, let's check another example. We can follow the same steps as before, but this time we will also use multiple time frames. Now, let's see how it works. This is the daily time frame, and the market is currently in a downtrend. We have drawn a trend line by connecting these points, and we also have a support level here. After the breakout, this support level has now turned into resistance. Additionally, the trend line and the support level are meeting each other, creating what is known as an area of confluence. Now, the price has started to approach this level, and we don't know what will happen next. The big picture shows a downtrend, but the immediate short-term trend is bullish. First, we need to observe how the price will react when it approaches this level. Currently, there is a hanging candle indicating uncertainty. However, even if the price reacts to this level, we shouldn't rush into trading immediately. Next, we need to draw a tight trend line similar to this. However, with this type of tight trend line, we may encounter fake breakouts. To address this issue, we should examine the same chart in a lower time frame. On the left-hand side, we have the daily time frame, and on the right-hand side, we have the 4-hour time frame of the same chart. The resistance line shown here corresponds to the daily chart, and we can also see the same resistance level on the 4-hour time frame chart. Similarly, the trend line visible on the daily time frame corresponds to the trend line on the 4-hour time frame. The mini trend line on the daily time frame aligns with the same mini trend line on the 4-hour time frame. If we observe the trend line in a bigger time frame, it appears to be imperfect. However, when we look at the same trend line in a lower time frame, it appears to be perfect and clear. This allows us to identify trends easily and gives us a chance to avoid fake breakouts. Now, we need to trade based on lower time frames. We observe that our mini trend line has been broken, and the price has also broken the previous low. This confirms that the short-term uptrend has ended. Currently, the overall market view is bearish, which makes it suitable for a short trade. However, it's essential to note that the breakout of this mini trend line is not the only crucial factor here. What matters is that this breakout needs to be rejected after an area of confluence. Now, let's explore reversal trades. To execute reversal trades during a trend, we need to identify specific price action patterns. These patterns include the double top, double bottom, and trend-changing patterns. Okay, let's see an example. If we observe that the market is in an uptrend, we draw a trend line below the candles like this. In an uptrend, the formation of higher highs is very important. However, in this case, the price has failed to make a higher high, and at the resistance level, the price has formed a double top pattern. This is a sign of momentum loss and also a reversal pattern. Now, we need to wait for the trend line to break. If the trend line breaks, we can take a short position. The same method can also be applied to a double bottom pattern. Now, let's understand the pattern of changing trends. Currently, the market is in an uptrend because it is forming higher highs and higher lows while moving forward. We have drawn a main trend line below the candles. However, we can observe that the price failed to make a higher high and instead made a lower high, indicating a loss of momentum. In an uptrend, if the price makes a lower high, it may indicate a potential trend reversal. Similarly, during a downtrend, if the price forms a higher low, it could signal a possible trend reversal. Once we observe these patterns, we should wait for a breakout to occur. If the price breaks below the trend line, it suggests that the market might enter a downtrend, allowing us to take a short trade position. Thank you for watching. We hope you found this video helpful and learned something new. Please tell us in the comments what topics you'd like us to cover next. Don't forget to subscribe to our channel so you won't miss our future videos. Good luck with your stock journey, and see you next time.